Did you know that a mutual fund's expense ratio doesn't capture all the fees you'll pay to invest? How can 2.27% in fees cost you 33% of your returns? And what free smartphone app can help you keep track of your charitable contributions? We'll answer these questions and more on this, the 63rd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 63rd episode of the DoughRoller Podcast. I'm your host, Rob Berger, and I'm glad you're joining us today. You know, I was talking to my wife about finances and, us kind of staying in sync with one another, and about having a sort of a meeting once a month to talk about our finances. I keep track of everything. I pay all the bills. I do all the investing. I do the budgeting. And I thought it would be good to, make sure we're in sync and have that sort of meeting or discussion once a month. We meet and go to a coffee shop once a week to talk about our week, plan out our week, our weekly goals, everything from our professional goals, things we want to do at home with the kids. We even plan out our meals. And we go to a local coffee shop in Vienna, Virginia, that's just wonderful. And it's kind of a nice time to get away and talk about the upcoming week. And I think I'm going to add to that once a month in that meeting a discussion about our investments and our budgeting and how much we've spent and all that sort of thing. But I was thinking about sort of we've been married 25, almost 26 years now. And, we haven't always seen eye to eye on finances. And she loves to tell a story about how when I was in law school, I went to school in Boston. And, if you've ever been there, any big city, parking is just awful. And I would literally have to drive around the block where we lived. We lived on Beacon Street, right near Fenway, right outside of Kenmore Square. And there were times when I literally would drive for 45 minutes to an hour, a couple of blocks from our home, just around and around looking for parking spots. And invariably, the parking signs and where you could park and when you could park, you need an advanced degree to understand whether you're allowed to park your car in a certain spot or not, depending on the time and the day of the week. And it's, ridiculous. One day she went out to get in the car to go somewhere, and she opened the glove box, and apparently, just dozens of parking tickets came cascading out of the glove box, and I guess tickets that I'd received from not parking correctly, and I had just shoved them into the glove box, and I'm sure most of them were past due. I remember that vividly. That was not a pleasant evening for me. I guess I share that with you as one of the personal finance mistakes I made in my life. Hey, listen, got a great show for you today. I got a money tool of the day from a reader named Greg, and I've got, we're going to talk today about the 4 hidden fees of mutual funds. If you think it's all just about the expense ratio, you'll want to hear this podcast. There are 4 hidden fees of mutual funds that you need to know about. Before we get to that, though, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment uses cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. And I guess I'm one of those 34,000. I didn't know they had that many. That's pretty good. Anyway, you can check them out at betterment.com/roller. And so, on to the money tip of the day. This came in from a reader named Greg. I had mentioned in a previous podcast how sometimes, you'll give, I know we give things away to charities, you give money, but also you might give clothing or other household items that you think might help them that you may no longer need. And at least where we live, they come to the house and pick it up, and they leave you a receipt, but of course it's blank, and it's up to you to, fill it out, list what you've given, when an estimated value, and so forth. And I'm constantly getting to tax time and finding these receipts that are completely blank. There's no date on them. I know I gave something. I don't remember when. I don't remember what I gave. And so a reader named Craig was thoughtful enough to send in an email. And here's what he said. He said, Rob, a couple of podcasts ago, you referenced itemizing donations and keeping track of what you donate. I use itsdeductible.com from TurboTax. They have an iPhone app, and it's very easy to use. You don't have to use TurboTax to use It's Deductible. check it out. Well, I did, and it looks like a real easy way to keep track of all of your donations. So you might want to give it a try. Again, it's itsdeductible.com, and it looks like a great iPhone app. I'm gonna check it out, and I appreciate, Greg, for you taking the time to email me with that. And by the way, I love getting these sorts of emails. Sometimes folks send me questions. Sometimes they send me topics they'd like me to cover in future podcasts, as Craig did. Sometimes they'll send me, a link to a great resource or tool. Very helpful, and I like to share those with everyone. So if you have anything like that, please email me, dr@DoughRoller.net. I love to hear from you, and I appreciate Craig taking the time to share that tool with us. Hopefully it'll help you as well. Okay. We're on to the main topic of the day, the 4 hidden fees of mutual funds. And this came, the source of this podcast came from an article that I read, written by John Bogle. As you may know, John Bogle is the founder of Vanguard. And he wrote an article in the Financial Analyst's Journal, one of the journals that I follow, and a very detailed article with a lot of data, a lot of graphs. Obviously, a lot of time went into this article. I will link to it in the show notes, of course, so you can check it out if you want. But I want to cover this. It's so important to your investing, and particularly long-term investing for things like retirement. And so I want to run through this. There are actually 4 hidden fees of mutual fund investing that don't get captured in the expense ratio. And that may come as a surprise to many of you, but it's true. And we're going to cover them, and then we're going to talk about the impact. So the first one is transaction costs. Mutual funds and ETFs, of course, are buying and selling shares of companies that the funds own. And just like we would have to pay a fee if we bought and sold shares, they do too. Now, they're, of course, buying on a much, much larger scale than we are. And that can help them obtain costs that are lower than ours on a per share or per transaction basis. But of course, they're buying and selling a lot of shares or shares of companies or bonds, as it may be, and those transaction costs add up. And believe it or not, they are not covered in the expense ratio. And if you think about that for a minute, you may be asking, well, why in the world not? But if we think about it for a minute, it kind of makes sense because they can't know ahead of time what their transaction costs will be. Particularly for an actively managed fund where they may be making decisions mid-year as to whether to stay in a stock or to leave a stock, and there could be transactions as a result of that. Likewise, with mutual funds, if there's a net outflow of funds, if more people are withdrawing their investments from the fund than investors are adding to the fund, they may have to sell shares to generate the cash to pay these shareholders as they sell their shares. That's not, by the way, so much an issue with ETFs because ETFs are bought and sold between investors. But with a mutual fund, when you sell your shares, you're selling them back to the mutual fund company. So there are a lot of different reasons why a fund has to buy and sell shares, and that costs money, and that is not reflected in the expense ratio. Now, Mr. Bogle goes to great lengths in his article to try to estimate, what that cost is. And he went through a number of studies that he mentions in the article. Some have estimated that cost to be as much as 1.44%, 144 basis points. Now, others have estimated it as low as 30 basis points. He pegs the cost for actively managed funds at about 50 basis points. So that would be on top of the expense ratio, you're paying another 0.5% on average, according to Mr. Bogle, in transaction costs. Now, we can perhaps debate whether he's got it right or not. Some may think it's more, some may think it's less. Obviously, it's going to vary from one fund to another. But whatever it ends up being, it is an additional cost on top of the expense ratio. And here's the thing, with index funds, they're not buying and selling as they change their mind as to what stocks they want to be in and what stocks they don't want to be in. Obviously, they're buying shares as new money comes into the fund. They're selling shares as folks perhaps leave the fund, and of course, they may have to buy and sell to continue to track the index. However, those transaction costs are so minimal that they oftentimes don't have any noticeable impact on the fund's performance. And there's an easy way to determine that. You can look at an index fund's performance, and if you think about it, they should, if they have no transaction costs, if their only costs are the expense ratio, they should underperform the index they're tracking by the amount of their expense ratio. And I've looked at Vanguard funds, and by and large, that's correct. I mean, they may be off by 1 basis point, but for particularly sort of the large cap U.S. Index funds, they're missing the index by basically the amount of their expense ratio. So as a practical matter, the transaction costs they don't even register on the radar with an index fund. But with actively managed funds, Mr. Bogle pegs that cost at 50 basis points. So that's the first hidden fee, transaction costs. The second one is interesting and one that may surprise you, but actively managed funds keep a fair amount of the money that we invest in them in cash. In fact, what Mr. Bogle says is that actively managed funds, on average, keep about 5% of their assets in cash. Now, that's, of course, going to vary from one fund to another. So before I go on, I want to just quickly tell you how you can find out how much cash any mutual fund has. Now, you could dive into the paperwork that they have to file with the SEC to figure that out, but there's a much easier way. Just go to Morningstar.com. I've talked about Morningstar a lot. I think it's a fabulous resource. You can search for whatever mutual fund you're interested in. I searched for Dodge & Cox Stock Fund, DODGX. I don't invest in Dodge & Cox anymore. I still have money in their international fund. I don't have it in the DODGX fund, which is sort of a large cap U.S. value fund. I have in the past. It was one of the funds offered in my 401k. I actually think it's one of the better actively managed funds. And but you can go in, you can search for that for any fund, in this case Dodge & Cox, and you can look at their portfolio. There's a tab for portfolio. It will tell you the percentage of assets that are in cash. Now, in this case, it's not 5%. They're lower. They're 1.86%. But I will tell you, at least in my view, Dodge & Cox Stock Fund is probably one of the best managed, actively managed. That didn't come out quite right. It's an actively managed fund that I think is one of the best run of that category. If I were going to invest in a large U.S. cap stock fund that was actively managed, for me, may not be right for you, but for me, Dodge & Cox would be high on my list. I'll also add, by the way, that while their expense ratio is certainly higher than an index fund, it's much lower than the average for actively managed funds. As of today, their expense ratio is 52 basis points. In any event, I mentioned that so that I want to equip you with the tools so that you can go in and figure this out for yourself. So if you want to know how much cash any mutual fund is holding, Morningstar, very easy way to do it. Now, here's what Mr. Bogle says about this average of 5% of cash in actively managed funds. If we assume that there's a premium for equity over and above cash, which we would, right? We're going to expect the return on equities over a long period of time to far outpace what you would get if you're investing in cash. He assumes a 6% premium for stocks over cash. Now, here's the key takeaway. If a fund has 5% in cash and we assume that stocks over the long term will return 6% more than an investment in cash, which I think is a reasonable assumption, that 5% in cash over a long period of time is going to cost you 30 basis points. It's going to cost you 0.3% in lower returns because a fund keeps 5% of its assets in cash. Now, for reasons that get a little complicated, Mr. Bogle actually assumes that the drag on your returns will only be half that, or 15 basis points. Why? Well, some funds can use options to effectively offset the loss that occurs by keeping so much in cash. I won't dive into the details of that. The key, though, is actively managed funds, on average, keep a lot more of their assets in cash than index funds do. Mr. Bogle pegs that cost for purposes of his paper at 15 basis points. At least from my perspective, I think that's a reasonable assumption. Again, I've also mentioned Morningstar, so you can check out your own mutual funds and how much they keep in cash. So that's the second hidden cost. We have transaction costs. He assumes 50 basis points. We have the cash drag, I call it, the drag on returns because of money left in cash by actively managed funds. That's another 15 basis points at hidden costs. The third hidden cost are sales loads. And there are really a couple of different kinds. The first would be loaded funds, where you have to pay, say, 5% fee to buy into the fund. And you may be, particularly if you're a do-it-yourself investor, you might be thinking, wait a minute, you're telling me there are mutual funds that charge 5% just to invest in their funds? Absolutely. And they use that 5% sales charge goes to the brokers for commissions that are selling you the funds. Now, the percentage of funds that charge loads today are much lower than they used to be. The sales charges are lower too. They're typically about 5% today. Decades ago, 8% wasn't uncommon. But there are still some funds that charge load, so there's 5% sales charge. A lot of people, even if they're buying no-load funds, are using an advisor to help them. And as I mentioned in podcast 62, the average cost of using an advisor is about 1%. So you've got that cost. And then even if you're not using an advisor, depending on whether you're investing in ETFs or what mutual funds you're investing in, there could be brokerage costs. So Mr. Bogle assumes another 50 basis points when you factor in all of these costs. Now, obviously, depending on how you invest, you can avoid these fees. You can't avoid the transaction costs. You can minimize them in an index fund, but you can't avoid transaction costs if you're investing in an actively managed fund. You can't avoid the loss of returns if your fund is got a lot of assets and cash. You can avoid the sales charges, the sales loads, direct and indirect. But a lot of people don't. A lot of people use advisors. And again, if you go to podcast 62, you'll get my take on that. I don't think using an advisor is wrong per se, so long as we understand what the costs are and how that will impact us and why we want to use an advisor. But it still is a cost. And so when he adds all that up and averages it out, he comes to another 50 basis points for costs for these various sales loads or advisor fees. So when you add the transaction costs, the drag from cash, and these sales loads or advisor fees, you add all of that to expense ratios, you get, for actively managed funds, a total cost of 2.27%. He assumes the average expense ratio of an actively managed fund is 1.12%, which I think is fair. When you add that together with those hidden costs, you get actively managed fund fees of 2.27%. Compare that to an index fund where the average cost is 0.06%. Now, at this point, you may be saying, okay, Rob, got it. You've walked through some hidden fees. You've only mentioned 3. The title of this was 4, so not quite sure where the 4th one is. I'm guessing you'll get to it. Fine, but you've walked through three hidden costs. Great. You've thrown some numbers at me. Fine. 2.27% versus 0.06%. Great. So what? I'm almost to work. How does this help my life? And the idiot in front of me is not driving fast enough. So can you please give me something to hang on to here? Sure, I'll do my best anyway. Here we go. Here's the so what. If we assume stocks return 7%, I think that's a modest assumption. If we assume stocks return 7%, losing 2.27% in actively managed funds to all of the various fees we've described, listen to this, it will consume almost 33% of your total return over a lifetime of investing. Let me repeat that. Assuming a 7% return on stocks, the 2.27% actively managed fees consume almost 33% of your total return. And you may be saying, you lost me. Math isn't my best subject. How do you go from 2.27% to 33%? The magic of compounding. Right? Not only are you losing 2.27% every year, but then the next year you're losing the interest or the growth you would have enjoyed had you not lost the 2.27% to begin with. And in 1 year, maybe not a big deal. 5 years, 10 years starts to hurt, 20, 30. As it builds up, it gets more and more and more. And according to Mr. Bogle, you end up losing almost 33% of your returns. Now, what does a 0.06% total cost of index funds consume in terms of total return? Less than 1%. That's the so what. And I want to give you an example to really put this in some more perspective. Let's assume you're 30, you're starting to invest, you're going to work until you're 70, so you're going to invest over 40 years, and you've got this choice. Do you go with actively managed funds and have these various costs eat away at 2.27% a year, or do you stick with index funds and obviously pay a lot less? What does that do to your nest egg. And Mr. Bogle actually goes through this example. He assumes someone's making $30,000 a year. He assumes a 3% annual growth rate, contributions to a 401k or an IRA in line with that kind of salary. After 40 years, your actively managed fund investments in a 401k will total $561,000. Not bad, huh? What about index funds that charge just 6 basis points? Not $561,000, but $927,000, a difference of $366,000. That's the so what. That's why costs matter. Not only the expense ratio, but these hidden fees that Mr. Bogle outlines in his article. Just another reason to favor index funds and ETFs over actively managed funds. Now, I promised you 4 hidden costs or fees, and I've only given you 3. So I'm going to make good on my promise. Here's the 4th one. Actively managed funds, by and large, are far less tax efficient than index funds. Now, if you're in a 401k or an IRA, that doesn't matter. But if you've got investments in the taxable accounts, it matters a lot. And in fact, I've gotten email from readers asking me about this, and I'm planning some podcasts that walk through the tax implications of investing, the tax implications between, say, investing in mutual funds versus ETFs and tax loss harvesting. I'm going to cover all of that in future podcasts. But today, I just want to focus on this 4th hidden cost. By and large, actively managed funds, because they're constantly buying and selling shares of companies because the management thinks they've got it figured out as to which companies will perform the best, they are far less tax efficient than index funds. Now, again, I want to arm you with a tool, and it goes back to Morningstar, and I'll stick with Dodge and Cox. If you search for any fund, one of the tabs you'll see, we were looking at the portfolio tab, right, to see how much they have in cash. That's fine. There's also a tax tab. And I was actually emailing with one reader about this. It's great because it'll show you both the pre-tax return and the tax-adjusted return. And Morningstar calculates what they call a tax cost ratio of each mutual fund. And it will give you a sense as to just how bad the tax hit will be for that mutual fund based on a lot of different factors, but primarily the capital gains that you could be hit with because they're constantly buying and selling funds, shares of stock. So that's a tool that can help you evaluate funds, particularly if you do have some actively managed funds. But here's the takeaway. Mr. Bogle calculates that, we mentioned you'd lose 33% of your total return with a total cost of 2.27%. Now, that was in a 401k or an IRA. Put all of that money in taxable accounts, and you add the tax inefficiencies of actively managed funds, and you actually will see this 4th hidden cost, combined with the other 3 we've talked about, will consume not 33% of your returns, but 43% of your returns. Now, I'll tell you, the one thing that frustrates me about the mutual fund industry, and really the investing industry generally, is it's so hard to get at this information. It's not obvious. And so I think it's fantastic that folks like John Bogle are writing the kind of articles that he's writing and shining some light on this. Now, his article, though, was in a finance journal that most people will never read. And that was one of the reasons I wanted to, in effect, bring that article onto this show to show you the impact that these can seem like insignificant things, even if you're aware of them. Most people probably aren't. I suspect a lot of people listening to this podcast had no idea that transaction costs from the buying and selling of shares of a company by a mutual fund aren't reflected in an expense ratio, or that so many funds hold a lot of money in cash, or that actively managed funds on the whole are less tax efficient than index funds. That could be new to a lot of people. But that's why I wanted to bring this information on the show, share it with you, and give you the so what, because this will have a big, big impact over decades of investing. Now, I want to finish the podcast with something that may surprise some of you. I don't believe all actively managed funds are evil. I think there are, most of my investments are in index funds, but not all of them. And I do think there are time and place for actively managed funds. Also, you may only have actively managed funds as options in your 401k, or to get exposure to certain asset classes, you may have limited choices. So I don't think all actively managed funds are bad per se, but I do think they deserve close scrutiny before you make an investment. I do think that there are some asset classes that are less efficient and can benefit from active management. I think, for example, active management probably is less helpful in, say, the large cap U.S. equity asset class, but it could very well be helpful in an emerging market fund, particularly, say, an emerging market bond fund, as an example. So I think some asset classes lend themselves to more benefit from active management than others. That's my view. While on the whole, actively managed funds are a lot more expensive than index funds. As I mentioned, not all actively managed funds cost 1.12%. That's an average. Some are a lot less expensive. Dodge & Cox, while I wouldn't describe it as cheap, 52 basis points is less than half of the industry's average. So not all actively managed funds cost you an arm and a leg. And some actively managed funds are tax efficient. Again, this is where we need to look beyond the rules of thumb. I think generally, for me, the core of my portfolio is in index funds, but I think there is a place for actively managed funds in some portfolios. And so I want to point that out. I don't want you to walk away from this podcast thinking that I think all actively managed funds are bad, and if you're in one, you're making some huge blunder. You may be. And that's really the point of this podcast, is to arm you with some tools and with some information so that you can do your own research and figure out what is best for you. Well, that brings us to a close today. I hope you enjoyed the podcast. A little bit of math today, I guess sort of diving down into the weeds, but this stuff really, really matters. It will make a big, big difference when you hit retirement. If you want the show notes, and hang on, let me hit the music. Here we go. Boom, there it is. Hang on, let me turn it up. I'm going to start it over. Here we go. Hey, if you want to get the show notes to this podcast, just go to DoughRoller.net/podcast63. That's podcast 63. If you haven't already, sign up for the weekly newsletter. That's DoughRoller.net/newsletter. It goes out every Saturday at 7 p.m., packed full of all kinds of personal finance and investing goodness. If you haven't yet, you can subscribe to this podcast and leave an honest rating and review to help me improve it. Just go to DoughRoller.net/iTunes. That will redirect you to the iTunes page where this podcast resides. Hey, and finally, love to hear from you. Questions, topics, tips, tools, whatever you got. Just shoot me an email at dr@DoughRoller.net. I read every email and I respond to every email. And remember, until next time, the best thing money can buy is financial freedom.